Tax-free Social Security benefits are something that most Americans believe is their right. And that makes sense to me. You paid into the system during your working life. What you get back out of the system shouldn't be taxed. But currently, that isn't the case. According to the Congressional Budget Office, it's estimated that roughly 50% of Social Security beneficiaries paid tax on their benefits. And that's by design. For the first 50 years, Social Security benefits were not taxed. But in 1984, President Ronald Reagan first signed into law a set of amendments allowing for up to half of Social Security benefits to be taxed in retirement. Then, in President Bill Clinton's first term, back in 1993, the Social Security tax was expanded so that up to 85% of your Social Security benefit could be taxed. So now, roughly half of Americans receiving Social Security benefits are taxed on them, and that amount increases each year. But many of us don't have a clue of how that tax is determined and if you can do anything about potentially lowering it. That's what I'm diving into on this video. The entire key to determine if your benefits are taxed is something called your provisional income. This isn't your total income that you received, and it isn't your taxable income. Provisional income is your adjusted gross income from your tax return without Social Security. Plus, you add in any tax-free interest that you received, and then you add in 50% of your total Social Security benefits. So what counts as income? Well, any wages that you receive, any interest and dividends, capital gains, taxable annuity income, taxable pension income, self-employed business income, rental income after expenses, and the kicker, retirement distributions from traditional 401k and IRA accounts. You then add all that up, and then you subtract any contributions that you made to traditional IRA or health savings accounts, any student loan interest that you paid, the self-employment tax deduction, any alimony that you paid on divorces before 2019, and any expenses related to moving for military personnel. This then equals your adjusted gross income. You then add any tax-free interest that you received and half your Social Security benefit, and you get your total provisional income. All right, got it? Well, at this point, you're probably thinking, well, what doesn't count as provisional income? Well, these are the things that don't count as provisional income. If you receive gifts or an inheritance, that doesn't make Social Security taxable. If you receive life insurance proceeds, that doesn't make Social Security taxable. If you receive welfare or SSI, that doesn't make Social Security taxable. If you receive child support, if you receive workers' compensation, if you receive VA benefits like disability or pension, health insurance reimbursements from insurance or flex spending accounts, they don't count. And the two big kickers, HSA or health savings account distributions, don't make Social Security taxable as long as they are used for medical expenses. And non-taxable portions of retirement account distributions. So qualified distributions from Roth IRA and Roth 401ks do not make Social Security taxable, and this is big. Okay, now that we know what provisional income is and what it isn't, how does it make your Social Security taxable? Well, for single people, if your provisional income ends up between $25,000 and $34,000, well then up to 50% of your Social Security benefit is taxable. And if you're above that amount, up to 85% of your benefit is taxable. If you're married and your provisional income is between $32,000 and $44,000, then up to 50% of your Social Security benefit is taxable. And if you're over $44,000, up to 85% of your benefit is taxable. But just because it's taxable doesn't mean it actually will be taxed. That's because all we've done to this point is figure out how much of your Social Security could be taxed. Now you have to figure in your personal situation. Do you use the standard deduction? Do you itemize deductions? And are you age 65 or older? This is what truly impacts whether your Social Security is taxed. I'm going to break this down into two parts. First up is for people who are age 62, 63, or 64. If you're between 62 and 64 and you use the standard deduction, that increased in the big beautiful bill. In 2025, if you're single, your standard deduction is now $15,750. That means the first $15,750 of your income is tax-free, and may mean that even though your Social Security is taxable, it still isn't taxed. Remember, only half your Social Security benefit counts as provisional income. If you're married and filed jointly, your standard deduction is now $31,500. So your first $31,500 of income is tax-free. Now, if you're 65 or older, you automatically get an additional $2,000 added to the standard deduction if you're single, and an extra $3,200 total if you're married. It's like a congratulations from the IRS for living that long. In addition, if you're single and have a modified adjusted gross income under $75,000, you get an additional $6,000 standard deduction. It's called the new senior bonus. If you're married and make under $150,000 total, you get an additional $12,000. This deduction phases out when your income is above that level. So here's the important point. That means for a married couple, 65 or older, with under $150,000 of income, your first $46,700 of income is tax-free. If you're single with under $75,000 of income, then your first $23,750 of income is tax-free. All right, now that we understand what provisional income is and how your Social Security is taxed, what we can do is keep those numbers as low as possible. And the best way to keep provisional income low is to have retirement income that comes from sources that aren't included in provisional income. Here's how you do it. Well, this episode on the channel is sponsored by Chapter. I'm partnering with Chapter because Medicare costs are through the roof. Millions of retirees are on the wrong plan, and I needed a company that I could trust to help my clients navigate Medicare. On average, retirees working with Chapter to choose their Medicare plans saved $1,100 a year. Chapter helps you stay in network with your preferred doctors and is the only national Medicare advisor that compares every available plan so you can be sure you're seeing all your options. They're completely independent Medicare advisors paid on salary, not a commission for selling you the wrong plan. When you call this number, you will speak with a real human in the US, so give them a call at 818-924-2041 or visit askchapter.org/CWM and let me know about your experience down in the comments. First up is the HSA, or the Health Savings Account. The HSA is a triple tax-free wonder. Using your HSA in retirement to help cover medical expenses, including Medicare premiums, keeps your provisional income low because distributions aren't taxed and don't count as provisional income. Next up, using your Roth IRA or Roth 401k in retirement can also keep your provisional income low. Because you paid tax on the way into these accounts, as long as 5-year rules are followed, when you withdraw funds from these accounts after age 59 and a half, the distributions aren't taxed and don't count as provisional income. Typically, income from rental real estate can be low provisional income if the tax deductions from depreciation offset the taxable income that's generated. And lastly, income from annuity payments is mostly return of principal until you reach your later years. That means the part that is return of principal isn't counted as provisional income. So annuity income, when structured correctly, can keep provisional income low for much of your retirement. The keys to having low provisional income are to have the majority of your assets in HSAs, Roth IRA or Roth 401ks, rental property, or annuity assets when retirement distributions are needed. You know what's the opposite? Plowing everything into traditional IRAs and traditional 401ks where you defer taxes into retirement and where every distribution results in increased provisional income. But unfortunately, that's what most people were told to do for decades. Maybe that was by design too. It really makes you wonder. It's important to remember that every family's financial situation and their goals are different. You should discuss any strategy you implement with your tax, legal, and financial advisors before putting it in action. And if you own a business and are looking for help optimizing your retirement savings to create a 100% tax-free income in retirement, you can explore working with me today by visiting celestialwm.com and clicking the Start Here tab to schedule an initial call. Still not sure you want to talk? Well, head over to my resource center and learn more about my financial planning process by watching my 35-minute complimentary training. And check out this video next in my series about creating a 100% tax-free retirement income.